So, welcome back, and today we're going to be talking about the risks and benefits of remortgaging. And today is going to be the final education piece on the benefits and risks of remortgaging and in the understanding remortgaging bracket. And in the next few videos, we're going to cover off the financial considerations that you should be looking at when looking to remortgage. But I'm going to kick off today by talking about some of the benefits and the risks of remortgaging for you. So we'll start off with the benefits. So the benefits of remortgaging are, and I know we've touched on this in the previous videos, but in a little bit more detail, this will allow you to secure a new deal with either your existing lender or a new lender. It's likely that if you are coming to the end of a benefit period, whether that's a fixed rate or a tracker rate, it's likely that you could end up paying more if you don't do anything, because typically a lender's standard variable rate is higher than the rate that you're currently on. Now, it's not always the case, but typically that's what could happen. But I can say with almost complete certainty that by reviewing your mortgage, there's a possibility, a really high possibility, that you could be saving money by switching your deal over to a new deal that better meets your requirements as well. Now, the process of remortgaging can be really straightforward. You can do it with your own lender. Mortgage brokers can do it with your own lender as well, and the process can happen pretty much instantly. So it's a really, really good and quick way to access your reduced monthly payments. But you also don't want to overlook the possibility of switching lender. By switching lender, the process can be a little bit more time consuming, but you've got that opportunity to do that when your deal ends. And as long as your deal's coming up to the end and you're not tied into your deal anymore, you've got the added benefit that there shouldn't be any charges for you to leave your lender or early repayment charges there. But some of the other reasons and some of the other benefits that people tend to remortgage is to access the equity in the home. So this could be for things such as funding a project. So if you're doing home improvements, if you're looking to repay debts and add them onto your mortgage loan, or even if you're looking to buy a second property and you're looking to release funds from your current home to put as a deposit on either a buy-to-let, elected buy-to-flip, or even a second residential property, holiday home, something like that. The key thing, though, is avoiding getting on to that standard variable rate that you might not need to. Now, if you are planning to review your mortgage, then getting on to the standard variable rate for a short period of time might not be a bad thing. But the key benefit is making sure that you're getting that deal secured at a rate that's going to suit your needs. But with everything, there are risks with things. So there are some key risks to remortgaging as well. And I'm just going to touch on the main two. These are the main two risks that I see and that I'm often talking to clients about when they are remortgaging. And the first one is if you're adding debts onto the mortgage. Now, by adding debts onto the mortgage, it could help cash flow, it could reduce your monthly costs, but it could end up paying, or you could end up paying a lot more in the long run by doing this, because essentially what you're doing is you're taking an unsecured debt. Say it's a personal loan with 5 years to run, you could be spreading that over the next 20 or 30 years. Now, yeah, it might save you money, but that monthly saving, you're actually spreading over a longer period of time, and it could end up costing you a lot more. So always take that into consideration. Always make sure that you're comparing the cost of keeping the debts in place for a short period of time, the monthly cost, the overall cost, and then compare the total cost of the borrowing over the full mortgage before making your decision. Because the last thing that you want to do is go adding it onto the mortgage, getting rid of all the debts, paying them all off, and then something crops up where you need to dip into your credit card again, or you decide that you want a new car or to go on holiday, and the debt starts piling up again. So it's a huge risk that you're taking. So make sure that you understand that before you do that. One of the other things is when you complete home improvements. So home improvements can be a great option, especially with the rising house costs. And I'm seeing a lot of people take advantage of releasing funds from their mortgage, whether that's through a remortgage or through a second charge with a specialist lender. But this can be a great way to avoid moving home, stay within the same home and create possibly more space, or just renovate the house that you're in. One of the key things that you need to understand, though, is that just because you're taking out 20, 30,000 pounds of a loan and you're putting that straight back into the house, doesn't always mean that your house is going to be worth 20 or 30,000 pounds more. You need to take into consideration what work is it that you're actually doing. If you're replacing a kitchen a like for like kitchen, so an older style, maybe 10, 15 years old kitchen that's working, it's functioning, with a newer model, it's not really going to be adding that much value on your, if it's going to cost you 30 grand, it's not adding 30 grand value onto your house. So take that into consideration. What it might do is it might make it easier for you to sell the house because it's more attractive to someone buying it. It could well make it more palatable to live there in a much more modern house, and you might feel better about it. But I certainly wouldn't be doing it on the basis that it's going to add value onto your house. You need to make sure that what you're doing is actually going to be adding value. Take into consideration a loft conversion or an extension. These are slightly different because what you're doing is you're adapting the property in a different way. So building that extension or doing the garage conversion, for example, these things could be appealing to potential buyers, and that could in turn increase the value of your home. If you're doing it with the anticipation that your house value is going to increase, I would always seek guidance on it. So talk to a valuer, get them out, pay 500 quid to get them out to assess your property and give you ideas as to what kind of things and what kind of value it would add. Because if that's the only reason that you're doing it, you need to make sure that it is going to be worthwhile. What you also need to consider is there's four main things that I've drafted out to consider when you are remortgaging. So I'll go through them really quickly before we finish off. So the first one is a product transfer. This can be the most straightforward thing to do. You stay with your own lender. It just changes the deal over when your current deal comes to an end. There's no real messing about with it, and it can happen fairly quickly. But you might not be getting the best deal out there. So what you can do is look to explore the market. But a product transfer is a popular option. But then we come to the actual remortgage. This is when you're changing lender. Now, remortgaging is very similar to buying a house, but it's a lot more straightforward. But it's similar in the sense that it is an application. So you would need to be supplying documents, payslips, bank statements, ID. You would then go through affordability checks and an application for it. Now, don't get me wrong, it is a lot more smoother and it's a lot more straightforward, but there is an application process to go through. And then at the back end of that, you've got legal work that needs to be done. And because the legal work's there, there could be fees involved for that. Now, if you've bought in the past using Help to Buy or the First Home Fund or a shared equity scheme, there may be additional charges on the property. Or if you've got a second charge in the background, these things could add onto the legal costs at the back end. So make sure that you're exploring that as well. But remortgaging is a popular option as well as staying with your existing lender. Debt consolidation, I know I've spoke about it a number of times. Just to reiterate, adding funds and adding things onto your mortgage could end up costing you more in the long run. And then the final consideration would be home improvements. The additional borrowing, it might not add the value onto the property that you're expecting. So always seek guidance on that before starting the work. So there's a few things that you can do to mitigate the risks when you are remortgaging. So it's crucial to do that, and I've touched on a few of the reasons there, but make sure that you're seeking advice, make sure that you're talking to a broker or even getting advice in by the bank and making sure that you're covering all the bases, because the last thing that you want to do is get caught short further down the line. So to mitigate the risk, make sure that you are taking advice on it, make sure that you're talking to the right people, you're getting all the right things in place. If you are planning an extension, make sure that you're getting your planning permissions, make sure that you're getting your architect quotes, make sure that you're talking to a valuer about the current and the future potential valuations of the property, so that when you're doing everything, you're doing it with your eyes open. And as always, this slide has been in a few of the videos now, and I'm going to reiterate it. Make sure that you think carefully before you add on any additional debts onto your mortgage, because by doing that, it could end up costing you more in the long run. Like every mortgage, a mortgage is secured against your home, and you do risk repossession should you not make the monthly payments on your mortgage. So by adding debts onto your mortgage, you're increasing that risk. And don't forget, if you are planning to remortgage, there could be early repayment charges to pay. So make sure that you're discussing that as well with your broker or your bank before completing on anything. That's it from today, and I look forward to seeing you in the next video. And thanks again for tuning in. As always, if you've got any questions, feel free to fire them over.